and we can start today's business meeting. I hope everybody had a lovely Memorial Day weekend. We're so thankful, and actually think thankful is not really the word to use, but that we have our freedom and others have sacrificed and serve. And we have a lot of our agents that are actual veterans or actual active duty. So we're really appreciative of the freedoms that we get from others sacrificing for us. And so today we have a special guest, Kokeshia Foster. She's at Green Balance Accounting, and she is our dear Shacarol's bestie. Are y'all besties? Is that how this works?
Childhood. It's great.
When we did Ignite a few weeks ago, we talked about expenses and things like that. And Shacarol was like, my best friend has already got me like lined up, ready to go. She's asking me where I'm putting my money, how I'm doing it. And I said, we need to have her talk to our agents. And so through text message, we got this lined up. And I basically told her we want to really know a little bit about like best practices and how we should be managing our money. And so Coco, as you're lovingly called, please share with us, introduce yourself, and tell us what you're going to talk about today.
Okay, well, I'm Coco Foster, owner of Green Balance Accounting. I've been in corporate accounting for about 13 years, and I made the switch from corporate to opening my own virtual boutique accounting and tax firm to assist small business owners with handling their books and their tax strategy as if they were a corporation, and trying to take advantage of the things that big businesses can, but small businesses can as well. The tax code is written for really two types of people: business owners and real estate investors. So when you're in business or you own real estate, you have to make sure that you're using the tax code to the advantage that is written. Unfortunately, for the everyday person, especially after 2018 tax cut, TCJA was introduced, as a W-2 employee, it took away a lot of the tax deductions that you were able to take and itemize and things like that. So when that happened, it really made it to where you needed a home-based business, some kind of side hustle, or opening your own business or invest in real estate to really take advantage of the tax code and the way it was written. So today we're going to talk about, I have an ebook that has 8 tax mistakes that can save you thousands. I'm going to try to get in 6. So, and then we'll touch on bookkeeping a little bit, because that's the base for all of it, is making sure that you have really good bookkeeping. And that's pretty much it. We're going to talk about bookkeeping and 6 tax mistakes that could save you thousands. Okay. Can I go right in, Katie? Or
yeah, that sounds awesome. I'm like getting pumped up. So I guess my level of geek has like raised, because I'm like super excited. Everything you just said got me stoked. So
now I have, if you can share, do I have?
Yeah, you should be able to share.
Mm-hmm. So if y'all need, just pipe in, Katie or someone, if y'all have a question at any point, because there are topics that we're going to hit, and I'll try to make sure to break at the end of each topic in case you have a question. Or would you prefer me to just wait till the end? It's totally up to you.
However you want to do it. If you want me to monitor the chat, I know it's hard to like do both. I can watch, but y'all feel free to put in questions and we'll bring them up.
I'll stop at the end of each topic because it builds.
Yeah.
So, and hopefully I'll try not to go over 45 minutes or so. Y'all let me know.
You feel free. Go as long as you want.
Coco, if you do, this is Vicky. We'll get you on a PC call, okay?
Yes.
Okay. All right. Well, I'm pulling up. Pull up my presentation. There we go. Did it pop up? It says, I think I need permission. It's not allowing me to share my screen.
Let's see. How do I give you permission? Advanced sharing options, maybe? All participants. There we go. Now try.
All right, there we go.
Yay.
Can y'all see?
Yes.
Okay. All right, so we're gonna talk about 6 mistakes that could cost you thousands. But first, before I go into the presentation, we're gonna talk about just bookkeeping. And a lot of people think about bookkeeping as data entry. And it's a little bit more than that, especially when you start adding assets to the picture. You know, if you don't have any assets or anything like that, if you don't have payroll costs, then it's not data entry, it's really organization. So what I like to tell people, especially realtors, is, you know, if you're not doing investing as well, like you don't have rental properties or flips and things like that, every month just sit down and have a money date with yourself and take your bank statement and have a separate one. Have a separate one from your personal, and go through it and drop everything into buckets. And so, of course, the deposits, that should just be all your commissions. That's all your revenue. And then take all the expenses, and your typical categories are going to be advertising, software tools, insurance, any kind of fees or subscriptions, you know, that you have to pay, your desk fees and things like that. You'll drop those into individual buckets, and you can call it whatever you want, just so you know what you're putting in there. So make sure, you know, you don't have to use the typical categories that are on your tax return. Those you can use because that's what your tax accountant will use, convert them to. But I like to use terms that you're going to use fluidly. That way you can easily explain it when you're having that conversation with your tax accountant. And I'm looking down at the screen because y'all's pictures are down here. So sorry. But just have a money day every month and drop those things into the bucket. And that way, when you get with your accountant at the end of the year, hopefully not at the end of the year, quarterly, so you can pay those estimated taxes, you can have a better conversation and you're prepared. That's like the first step to making sure you're having, you're set up to implement any tax strategies that you're planning for and have a meaningful conversation with your tax accountant. So the next thing, you can use software. QuickBooks is great. They have QuickBooks Self-Employed. QuickBooks Self-Employed is not double entry accounting. So the next step up is like their Simple, Essentials, and Plus plan. And that is more of an accounting system. So it'll create a balance sheet for you. So if you have assets and things like that, self-employed is not, you know, going to be sufficient enough for what you need. Like if you need to provide a balance sheet and not just an income statement, then you'll need to upgrade from QuickBooks Self-Employed to a QuickBooks Simple Start or Essentials. And I think Simple Start is maybe $15 a year. It's just an easier transition if you're already in one of those programs versus the self-employed. The self-employed is really for that quick start, getting things together, trying to keep costs low. That it works. But once you create that base, you also want to do your quarterly estimated taxes. The IRS is a pay-as-you-earn. So as soon as you jump from W-2 employee to self-employed, the IRS, you now have the responsibility of paying. It's not an option when you're working for someone else because they're automatically going to pull it out. So you pretty much, when you're paying your quarterly taxes, it's like a mini return, and you want to do it full scope. So you want to project what you think you're going to make for the entire year. And then every quarter you sit down and do that return. If you have a kid, if you're married, if you're single, you do a mini return and see what those deductions look like and how much you would owe. So it's not just based on your revenues, it's based on your net profit, and then taking into consideration the tax deductions that you'll be able to apply when you actually file the return. So you want to make sure you're doing that and you're not paying too much into your quarterly taxes. A lot of people, I find, they'll just take what they made and pay 20%. That's fine if cash flow is good like that, but for everyone it's not. And you know, everybody doesn't want to just pay that lump sum in advance when you don't have to. If you do that, more than likely you're going to have a refund at the end of the year, and they're not going to give you interest. So think about it like that. Any questions just on the bookkeeping and quarterly estimates before we jump into the actual presentation?
Is there a tool, Kokesha, that they could use for like simply finding that out, or should they just estimate the year and then divide it in quarters?
Well, yes and no. The IRS has a tax tool
Okay.
that you can estimate it, but being a business owner, there are tax advantages, tax code, tax deductions that you can take advantage of. And without knowing how to apply it, you can't just easily just say, here's what I made and here are my expenses on the books. There are other deductions that you'll be able to take advantage of, like mileage. And that's a tax deduction. It's not a financial, it's not a, it doesn't belong on the income statement per se. It's more of a tax deduction. So
what you're saying is everybody should use a tax professional,
yes,
especially realtors, because you're going to miss out if you don't have somebody that knows real estate and the deductions that are eligible, right?
absolutely. We're really talking book basis versus tax basis, two separate things. What you can call an expense on your books may not actually be an expense on the tax side, or you may not be able to take that expense 100%.
Awesome.
So you definitely want to consult someone to make sure that you're taking it properly.
Thank you.
All right, let's jump into the presentation. So the first thing we're going to talk about, did it jump? All right, there we are. Failing to plan. So you guys ain't going to business to be an accountant. So the last thing you want to do is sit down and do your books. No one wants to do that. No one wants to think about taxes and coming up with a tax strategy. And the only way for you to really put more cash in your pocket and have less expense is to have financial offense and financial defense. Financial offense is you increasing your revenues, making sure that, you're getting the commissions, you're getting yourself out there. You guys can do that in your sleep. You know how to make more money. But financial defense is how do you keep more of that money in your pocket versus writing a check to the IRS at the end of the year or every quarter. So financial offense, financial defense, more cash and less expense. And tax is one of the biggest expenses that small business owners have. So you just want to make sure that you're planning for that. Whatever your biggest expense is, I like to line my income statement with, not my income statement, when I do my analysis spreadsheet, I want to see what my top 5 expenses are. And every quarter, every year, how can I decrease those? Whether it's 1%, 2%, 3%, I'm trying to move the needle down so I can keep more of my money in my pocket. So the first one is a home office deduction. Now, I know a lot of you guys, I know some realtors, they actually have their office at Keller Williams, and you have to pay, your desk fees and things like that. But you can also have a home office deduction. And that's because it's your admin office. So if you're going home and when you do your books, when you have that money talk with yourself, when you're planning things, that is a home office and that's your admin office. So you have the corporate office, which you have to pay, you pay for, but your home office is your admin office and you can take this deduction. So the first thing is to make sure that you have an exclusive area and a principal place in your home. That's your home office. Now, if you're audited and they come to your home, they don't want to see, a playground in your room. They don't want to see, your kids' stuff. They don't want to see that your husband uses it to work on his, toy cars or whatever the case may be. It needs to be exclusive and the principal place that you're doing your admin stuff at, okay, for your business. There are 2 different methods. You have the traditional method and the simplified method. Now, the traditional method is when you basically take all the expenses of your home. So your interest, utilities, any kind of expense, like let's say you have a housekeeper, you get the yard maintenance. All that's an expense to your home. You take the square footage area of that home office and the total square footage of your home, and you can write off that percentage of those expenses on your taxes. Now that's the traditional method. The only thing with the traditional method that I always advise, if you're gonna sell your home in the next 4 to 6 years, you wanna be careful with depreciation recapture, because with the traditional method, you have to recognize depreciation. Okay, so you get to write off those expenses and depreciate the home, but if you sell it, you may have to go back and recapture some of that depreciation expense. Now, the other option is the simplified method, which is that you can write off up to 300 square foot of your home, that's your home office, at $5 per square foot, which comes up to about a $1,500 deduction. So it's one or the other. There's no depreciation, recapture, or concern with the simplified method. It is just straight $5 per square foot of the office area, up to 300. So one or the other. The traditional could definitely, depending on the size of the home and the amount of expenses you have, could be more of a lucrative deduction, but simplified keeps it simple. You don't have to worry about it, and you don't have to keep up with all the expenses. So it just depends on, you know, how detailed you are. Most people lean towards the simplified method though. Any questions on home office deduction? Okay. Meals and entertainment. So with the latest tax code that came out in 2018, they did 0 entertainment deduction. And entertainment is, you had a lot of corporate businesses buying season tickets to football games, baseball games, like lavish, extravagant vacations, the board of director meetings and things like that. And they always had some kind of entertainment factor. You can still have those things, but the piece of it that's entertainment cannot be deducted. So you can buy that baseball, those season tickets. However, you can't use it as a tax deduction. It'll just stay on your income statement, and we'll simply cross out that line when we're including it in your expenses for taxes. Now, if there is a meal that is consumed while you're entertaining your client, then you can deduct that up to 50%. But the cost of that entertainment, you cannot. That is just strictly a business expense. It is not a tax expense. So that was gone, and that hurt a lot of people. A lot of salesmen, especially big business sales guys, were very upset about that because can't do that anymore. 50% for dining. So if you take a client out, and it's just 50% for you. You don't necessarily have to pay for that person's lunch as well. You just need to document it. So if you go to lunch with a client, if you go to lunch with other colleagues, other agents, take a picture of that receipt in that moment, jot down the name of the person that you're eating with, and then what you guys are talking about. If it's just real estate, or maybe it's a flip, or whatever the case may be, jot it down. You may even want to write the address of the home that you're jotting down if you want to be more detailed. I'm not big on paper. I'm 100% virtual. So I don't want your receipts. I don't want your paper. I like to tell people to take a picture of your receipt. Google Drive, Sync is my choice of online storage, but they all have great apps that you can take a picture within that app. When you take the picture, have a folder set up with the year and the months, and drop that picture in that month, in that year, in that month, okay? Now you can go even deeper, and within that folder, you can have like a folder for office supplies, a folder for meals, a folder for gas receipts, and just take a picture, drop it in that folder as you're going. That way you don't have to keep up with that at the end of the year. And now you have it organized by month and by year for your tax accountant if they need to go and refer to your receipts. So that's my easy way of people on the go, keeping up with receipts and things like that.
So you're saying you don't want my shoebox full of like crusty, wadded up receipts with bubble gum on them?
I don't want.
But I keep them in my purse for like 6 years. You sure you don't
keep
want that?
No. I don't want that. Now you do have to keep copies of them. And while we're kind of bringing that topic up, typically your tax accountant, they'll want to see just a summary. Your bank statements, that's enough verification that we need. You bear the responsibility to prove that these expenses are valid if you're audited. So your tax accountant isn't necessarily auditing you and saying, you got to prove to me that this was actually for business use. If you tell me that, I'm looking at your bank statements, I see that there's some kind of proof. There's no reason for me to question or dig any deeper. I may have to make sure I do my due diligence, but I don't have to audit it. So, but you do have to keep them I would keep them for 3 to 6 years if they're virtual, just because if you're audited, there is no limit as to how far the audit can go back. Once that door is open, they can go back as far as they would like. So keep that in mind. Take pictures and document as much as you can. Dining, 50% off. You get a 50% deduction, not 50% off, 50% deduction. And in office, you get a 50% deduction. So that's for water, Cokes, anything that you need, like you actually have your own office. Then if you need to entertain your guests, even if it's at home, you invite clients into your home office, you can deduct 50% for snacks and things like that that you want to supply to your clients as a courtesy. Company functions and company events, that's 100%. There needs to be more, if you have employees, there need to be more employees than family. So that's the fine line for company functions and events. So for instance, if you have a Christmas party and it's your entire family that are your employees, you can't deduct that because now it's just a big family party. But if you actually have employees that are non-family members, you can deduct that, all the expenses, 100%. You put on seminars and things like that, 100% write off. Whatever you have to pay to hold that seminar, you can write that off 100%.
Morning, big.
Sorry?
You're good. I just muted everybody.
Oh, okay. No more questions. I'm going to go over to the next one. So your auto deduction. So the standard mileage, it changes every year. I think next year it goes to 59 and a half or something, or yeah, 59 and a half. There are two ways you can do this. You have the standard mileage and actual expense. Typically, as a realtor, you want to use standard mileage. You're going to get more bang for your buck in that way. But sometimes actual can be more of an advantage. Now, I have some realtors that have a car that's exclusively for when they're showing homes, when they're driving around 100% and they have another personal car. That definitely makes it easier to say that, hey, whatever expenses I have on this vehicle, it's 100%, and this is my personal car. Makes it a whole lot easier to say, let's just write off the car or the actual mileage. But with actual versus standard, when you want to decide between those two is when, let's say, for instance, you have high mileage and the cost of the vehicle is kind of low. Maybe it's like 10,000, maybe even 15. And you're going to keep it, it's there for the long haul, then you want to go with standard mileage, because once you pick a deduction, a method for that vehicle, it's for the life of that car. So you can't pick standard this year and go to actual the next year for the same vehicle. It has to be a whole new vehicle in order for you to switch which method to use. But if it's a low cost vehicle and you have a lot of miles, then you want to pick mileage. Let's say you have a $15,000 car. Well, you'll probably write that off for about 3 years. If it's 100% in use, then that's a $5,000 deduction because you're going to write off that vehicle, the cost of that vehicle. Now, if you're using mileage and let's say you do 10,000 miles a year, well, that's 5,800 bucks, right? Well, by year 3, if you had taken actual expense, you don't have a write-off anymore. But if those miles are still racking up in year 4, year 5, and you chose standard mileage, you're still writing off that mileage every year, but you no longer have the expense of the car. Maybe it's paid off and you just have insurance expense. Write off the mileage. Like Uber drivers, they should never have to use actual. Now, let's just say you have a luxury vehicle and you use it 100% for your business. You go in and you buy a $50,000 car and your mileage is low or it's kind of cutting that line. I would use actual. If you lease your vehicle, it may be more of an advantage to probably write off the lease versus the mileage because you have to stay within the mileage range for leases. But this is definitely one you want to put pen to paper and write it down and say, hey, this is what I normally do. And here's the vehicle that I'm driving, the cost, and how long I plan to keep it. This is one where you definitely want to have a strategy because it's for the life of the vehicle. Any questions on that? No hands raised? Okay. The next one I'm going to jump into is one that is shown a lot on social media. So there's a proper way to do this and an improper way to do this. So Hiring your kids. If you don't hire your kids, then you're losing out. Now you got to make sure it's age appropriate. You can't just hire your kids and they're 2 and 3, even 5 and 6. Like, you got to be careful with what they're doing. They actually have to have a job. But there's a proper way to hire your kids and write off up to $12,000. Now, this shift happened. You can always do this, but it became more an advantage when they changed the standard deduction. The standard deduction for a single back, and before 2018 was like $6,000. So still a nice chunk to write off and pay your kids. But once it jumped to $12,000, that meant that any person, everyone who files a return, who earns a wage, you don't pay taxes on the first $12,000. So when you hire your kid, you can pay them $12,000, and that's a write-off for you, and then they don't have to pay the taxes on that $12,000 because you get a deduction for that amount. So in order for them not to pay, there's a certain way you have to do it. So if you're an LLC or a sole prop, then you simply can transfer the money from your business account to your kids' account. You don't have to issue a 1099. You don't have to hire them as an employee. If they're 17 and under, they're not responsible for Social Security tax. So no Social Security tax on the $12,000 and no federal tax on that $12,000. It goes straight to them as a 1099. You file that return. If it's $12,200, it's going to deduct it, and that taxable income is going to drop to 0. And other taxes is going to display 0 because they're 17 and under, and they don't have to pay. So you don't have to file a return. There's no need to file a return for your kid if they're 17 and under. Now, on the state side, typically, depending on the state, there's very minimal tax, if any. And we're talking none. For state of Alabama, there's typically none. You don't even have to file a return. In other states, you will, but you're good in Alabama. You don't have to file a return. Now, if you are a S Corp, and we'll talk more about S Corps in a minute, if you're an S Corp, then it's a different process. So the corporation can't directly pay your child. So you have to set up a holding company. So you would just transfer the money. It's like you have 2 businesses. You have your corporation, and then you have this other sole prop. Doesn't have to be an LLC, but it's like a holding company. It's like your side hustle. And your child works for that side hustle, okay? You would transfer the money and from the S Corp to that account, to that business. And then that business would then pay your child. The reason you have to do that is because since they're family, you would have to hire them as an employee in the S Corp. It's just a rule of a corporation. But you don't want to do that if you don't have to. So you just transfer that money to a holding company, and then they work for FMC Holding Company. They're contracted with them, and you transfer the money from that company to your kid. Does that make sense? All right, is anyone here at S Corp? No? Okay.
Nobody said anything, so.
Okay, I'm going to assume everyone's an LLC. We're going to talk about S Corps in a minute, and that may spark your interest about it a bit more if you haven't already heard about S Corps. But you can pay $12,200 for 17 and under, no self-employment tax. Now, when they turn 18, self-employment tax kicks in. The self-employment tax, and the reason at that point is because it's made up of 2 things, Social Security and Medicare. So once you turn 18, you're building up the income in your Social Security bank. So you have to start paying in once you turn 18. Until that point, you don't have to do that. You don't have to pay into that. There's just a proper way of doing it. Now, I like to go another step, have a job description for them, keep track of what they're doing, the actual duties that they're performing for you. And, when you're paying that money, whether it's weekly, monthly, you want to do it consistently, but just document it. You don't actually have to get QuickBooks payroll or Gusto payroll or anything like that, but document the hours that they work, the duties that they're performing, and show the transfers over. Now, how you manage that money, totally up to you. If your kid is actually working and you're paying them, let's say, $6,000 a year. Well, once the money hits that account, you mean you're managing them, you're the guardian. So if they have tuition that needs to be paid, pay the tuition. If they need to go to the dentist, if they have, whatever the case may be, if they need school clothes, they're in their extracurricular activities, you manage the money. Another thing you can do is if you pay them $12,000 a year, and that's the max, every year they increase the standard deduction, it'll increase. So next year it may be 12,400. It continues to go up. That doesn't have to be the goal initially. You can always work up to the $12,000. It may simply be $2,000 the first year. That's a great start. That's $2,000 that you're not paying taxes on, and your kid is not going to pay taxes on. So that's just a way to save it. So, and you're changing the way that you think. Like, I have one employee that was like, she kept forgetting, not I say employee, one client, she kept forgetting to use her kid's card when they were swiping things. And so she got to the point where she's like, she started doing it consistently, paying them on a regular basis versus, oh, I forgot to pay you, swipe my own card. But before you swipe your card, just think that you're swiping your card and you're paying for expenses with tax money, because you're going to pay taxes on it, when you could have simply hired your kid to help you with some admin stuff, whatever the case may be. If you have real estate that you're managing, they're mowing the lawn, you could have hired your kid and transfer the money to them and swipe their card. And now that money is not taxed at all. It is literally no self-employment tax, no federal tax. You earned it, you swipe it, no cost. So you're living off tax-free money. Your kid is. I mean, $12,000 is a lot, but I know we pay way more than that for our kids in a year's time, but it's a good savings to have. So I kind of shifted there on that, but just kind of, change your thinking about when you're using your card, hire your kid, save the money, and it's going to go up every single year. Just document it. Just make sure you're keeping the documentation for that. Any questions around hiring your kid?
Coco, how old do they have to be?
What was that?
How old do they have to be?
It depends on the job. So it has to fit their age and their ability.
So
So
they can file papers
then you can hire her to file papers.
and clean my office.
You can hire her to clean your office, file papers. I mean, you have to think, like, some photographers have their babies and they use them for advertising as models. So you can hire your kid for the day. Let's say you want to get a new photo shoot, and you want to have for your advertising and marketing, and you want to do a family shot. Well, you can hire your kid for that day to be in that photo shoot. It's a one-day thing if that's not consistently your business. But photographers, if you see the pics on there, if they have a good tax accountant, their kids are getting paid to sit there and take pictures with mommy and daddy or whoever the photographer is, and they're getting paid and they're saving taxes. So you just have to document it and make sure they have the ability to do it. That's it. And I mean, if you're on, now I'm not huge on social media, I'd have to get better, but if you're on social media, then video it, do a story with your kids sitting there working and, with a cute quote. There's proof there that, hey, they're actually doing the act. You're not making it up, and it's visible on social media. So there's a way you can do it. Just make sure that they're actually doing the job. Any other questions? So to answer that, the age doesn't matter, ability to perform the job.
Can you hire more than one kid?
There's no limit on the number of kids you can hire.
Okay.
And it doesn't necessarily have to be your kid. Let's say you have a niece and your niece is 16. You still don't have to issue that kid a 1099. Now you're not going to have the, they have the tax savings on their side too. So you don't have the benefit of managing their money unless that kid, your niece, lives with you and you're the guardian, but it's the same thing. If they're 17 and under, there's no need. And that's still a deduction. They're contractors. They just happen to be your kids. So they're workers.
So,
They're-
so Coco, does this money have to be spent within the year, the salary, or
No.
can it be like saved for college each
It
year?
can be saved. I'm glad you said that, because that's where I was going and I got off track. It does not have to be spent, but you do have to send it to them. So this is one of those things where if you haven't transferred that money by December 31st, you lost out. So you can't wait until the end of the year to start implementing tax strategies like this because it's too late. But another thing you can do, let's just say cash flow is great and you don't need the money. Once you pay your kid that money, you can start an IRA. You can put that money in a traditional IRA and or a Roth, whatever the case. They're not paying taxes on it. So now you're putting money that you aren't going to pay taxes on. Your kid doesn't have to pay taxes on, and it's going to go into an interest-bearing account. It's going to, you're going to start their retirement planning or their, college planning, college savings. You can just transfer all that money right into a Roth, and there you go. You can set them up on a solo 401k. Like you can do many things with that if you don't need the cash flow. So doesn't have to be spent. It can sit in an account or you can transfer it and set up an IRA. And then, with IRAs, you could do self-directed IRA. Maybe you want to set up an income producing property within an IRA. So you're going to take that money and drop it in one and buy a house with it, let it build and buy a house, that could produce rental income or flips, whatever the case may be. Endless things you can do. The same thing that you can do with your money, you can do it with your kids' money. You're just going to manage it.
Okay, Coco, let me ask you a question. So go over that same spiel with if they're over 18. You just have to transfer it to them by?
No, okay. So good question. If they're over the age of 18, now that does trigger for them to have to pay self-employment tax.
Mm-hmm.
Now, you don't have to bring them on as a W-2 employee. You can still pay them as a contractor. You will have to issue them a 1099 at minimum. But at that point, when they file their return, they'll pay self-employment tax on that $12,000.
Okay.
Now, you want to be careful because if they're over 18, or even if they're not over 18, when they become over 18, if your kid is working another job, then you have to kind of look at it and make sure you're not putting your kid in a situation where now they owe taxes. But even if they do, though, the amount of tax that they pay versus what you would have to pay, probably peanuts, because them making $12,000 may put them still in an okay tax bracket. But if you have that $12,000 on your side, that could put you in a whole nother tax bracket. And you're like, wait, now I got to pay 30% on this $12,000 versus 10% or something, or 22%. So it could just be peanuts, that they're paying, and you could literally pay it for them in a form of income. So, and that's what a lot of beer companies do, like especially when they're the family-owned company. And so you have your kids as shareholders. So I have one client, they get distributions. They have a family business where they rent out commercial space. They own the commercial space, they just rent it out. Well, at the end of the year, they get a big check for like $60,000 or something. Well, now they got to pay taxes on it. Well, what they do is that they issue them another check. It's a distribution that's going to count for the next year, but the company just paid the taxes as income, but it's just kind of recycling itself. You get what I'm saying? So that's probably what I would do. I would just stroke another check and pay the tax bill, but hey, this is income, so it's also a deduction.
Okay, let me ask you one other question. So if you have a child that's over 18 and they're an independent contractor, would this same tax, the thing that you're explaining to us, the way to do our money, could they do theirs the same way?
Absolutely. So if they have their business, let's say let's say your kid owns a landscaping business.
Mm-hmm.
If his son works for him or his daughter, whomever, they could do the same thing. They could hire their kids and transfer the money over. Same thing. It's just 17, you don't pay self-employment tax. 18 and older, you do pay self-employment tax. That's the only difference.
So all of these benefits that you're going over with us would apply to them because they have their own business.
Yes.
Okay, that's okay. Thank you.
So I want to tag on something, if that's okay, Coco. What we're talking about when we talk about, we have a book, The Millionaire Real Estate Agent, and it goes over the expense model, and it's about taking every, the 100%, you divide it up where 30% is expenses, 30% is cost of sale, and 40% is profit. This is how you get in those margins. You take every dollar and you make the most of it, and that's exactly what Coco's talking about. Is not just taking it at face value. And that's why you have a tax professional that knows how to explain this. Like, I feel like I understand everything you're saying, Coco, and that like makes me feel empowered. And so that's how you want your tax professional to talk to you. So that's just all I want to say. So anyway.
Any other questions? All right, so now we're gonna go into the last one. This one is a little lengthy. I have a couple of slides that I hope that I'm explaining this. We're going to talk about LLC versus S Corp. I don't know if you guys heard of, know much about S Corps, but the second half, this is the last topic. We're going to go through that, and I'm going to show you guys an example of how you can save money once you reach a certain point in your business if you convert to an S Corp, okay? So the biggest benefit of an S Corp is to reduce the amount of self-employment tax that you pay, okay? I like to tell people once you hit about $40,000 to $50,000 in net income, not gross, net income, that's where you want to consider and start talking about the S Corp. And at that point, you'll see the savings. The first year would be kind of a break even with the setup of the S Corp, the admin cost. Excuse me. So you'll probably break even if you're about at the $40,000 to $50,000 net income line. The following years is when you'll really see it, and as your business continues to grow. So once you convert yourself, you have to make yourself an employee and pay yourself a reasonable compensation. Now, reasonable compensation is debatable amongst all tax accountants and professionals everywhere, what that number is. There have been studies, some people use a percent base, some people use salary comparisons. It really just depends on your tax accountant and what you guys think is reasonable. So I also like a consideration when you're wanting to invest, and I know you guys know this better than anyone. If you've ever dealt with a client that's an S Corp that has W-2 income and takes distributions as well, it can sometimes be a headache getting them approved if that lender or that bank isn't knowledgeable, that person you're working with, about S Corps and how they have W-2 income and distributions. So a lot of times, some people that are converting to S Corps want a higher salary, so their W-2 income doesn't cause them not to get financed versus the distributions. So I always tell my people, make sure you know who your lenders are, shop your lenders, and make sure that they're knowledgeable about business taxes and they have an understanding of S Corps, because two different streams of income, but one bucket. They come from the same place. So when you convert, did it go over? There we are. When you convert, it's gonna be, you pay self-employment tax on your net profit. Okay, so whatever your net profit is, you're going to pay 15.3% self-employment tax, and then you're going to pay whatever the marginal effective rate for your state and federal income tax. But it is after you deduct all of your expenses from your revenues. That's what you're going to pay self-employment tax on. You don't take the standard deduction, you just pay self-employment tax on that profit. Boom. So if you have an income statement, whatever that net income line item is, times it by 0.153, that's your self-employment tax bill. So for 2019, that limit was up to $132,900. So basically, if you have W-2 wages up to that amount, that's what you'll pay self-employment tax on. Now, self-employment tax is made up of two things: is Social Security and Medicare tax. Medicare tax is 2.9% of that, and that does not have a ceiling. So you'll pay the up to 130, you'll pay, what is that, 12.4%? Yeah, 12.4% on Social Security up to 132,000. And then Medicare will continue. If it's 200, 250, it'll continue at 2.9%. You'll always pay into that. But Social Security stops and maxes at 132,000. That limit goes up just like standard deduction every year. So it continues to climb. Any questions there? Okay. So we're going to jump into the example. So if you are an LLC, and let's just say after your expenses, you have a net profit of $100,000, then you're going to pay 15.3% in self-employment tax. Now, right under there, I put 92.3% of income. So probably too much information, but that $100,000 is really, you're going to pay self-employment tax on $92,000. They take 92% of your income up to $132,000. Okay. So that's $92,000 at 15.3%. You have a self-employment tax bill of $14,000. That's a lot of money. Especially, I like to explain this like that $100,000 is like your gross wages if you were employed somewhere. That's like your W-2 gross wages. Those are your wages. And so if you were a W-2 employee, your business, your employer would be paying half of that. But once you decided to step into entrepreneurship and become your own boss, now you have to take on that hat 100% and pay that full 15.3%. It's no longer split. So you used to pay 7.65%. It's jumped to 15.3%. Okay. So this is that FUTA, SUTA, all that on your W-2. That's what this is. So that's $3,500 per quarter, just in self-employment tax. That's not including federal. So if in first quarter you made $25,000 and you're projecting that you're going to make $25,000 per quarter going forward, then the self-employment tax piece, if we don't have any other deductions, so let's just say all the other strategies that we've talked about, you're not taking advantage of them, then you would pay $3,500. Or let's look at it a different way. Maybe we have taken advantage of all those other things and you still have $100,000 self-employment tax. Okay, that makes sense? No, so a single taxpayer, and I did all these numbers just based on single. I have some others that I jotted down for like head of household, married filing jointly, and things like that. But for the examples in the presentation, it's just single. So at $92,000 with no other deductions, you would pay $13,600 in tax, in federal tax. Not including the self-employment, this is just federal taxes. So that would bring your total as a LLC to about $31,000 for state, federal, and self-employment tax on a $100,000 profit. So you would walk away with a little under $70,000. Now, it's not bad. You know, some people look at having to write that check as a negative thing. It's something good. That means you made money. You know, that's a good thing. At that point, it's just, how do I keep more of it? Having to write that check is not a horrible, I'd rather write a check than not have to write a check, because that means that I'm not making enough money to have to owe anything. And taxes aren't going anywhere. Embrace it and plan for it. They're not going anywhere. Embrace it. You gave the percent totals earlier. I like to do a base just starting out until you figure out what your operation expenses are. 30, 30, 30, 10. 30% for operations, 30% to pay yourself, 30% for taxes, and 10% for savings. That's kind of like the base. When I get new clients, I say, let's just start here. And I also kind of like to push for them to have those bank accounts in the same way. Have your operational bank account, have your savings account, have your, of course, your personal account, and then your tax account. So you're just putting that money over there. So if you get $1,000 commission check, if you can, go ahead and put that money in those buckets. And that way it's accounted for. There's not a question about it. The money is reserved, it's there. Now, if you're really good at managing your money, you may say, I can't do that right now, but then there's a build, and then you get one check and you're like, this is 100% gonna go to taxes and savings or taxes and operations. Then that's great. But some people really have to manage it by invoice. Once they receive that commission check or that invoice payment, you kind of go ahead and slice it up, because that's the way you have to manage it. So you have to find what works best for you, but I would definitely do that, because you're not going to get around taxes. It's just not going to happen. Any questions on the LLC example?
I don't see any questions. Does somebody else have a question? I don't see any in the chat box. But I do want to say, you know, Coco, I interview a lot of realtors, and when we talk about how much they want to make, their goal, it's always $100,000. And so this is a perfect picture of that, because you need to go ahead and prepare as you're trying to earn and create the plan to make $100,000, that this is the awareness you need to know, right? This is what it's looking like. You can go ahead and allot for that. So we're being realistic and planning for it.
Right. And these are all strategies. Like, you don't have to implement them 100%, but it's easy to do, you know, because you're going to spend the money. So it's really about documentation and making the decision and laying out the whole plan. This is what I'm going to plan, and then managing that plan. And then, you know, doing a quick analysis, just kind of a checkup to see where you are. Are we on track to do what we said we planned to do last year? That's all it is. It's just managing. Having that money talk in a strategy is very important. So we're going to jump into the S Corp strategy. So there's two parts of how you will pay yourself, how you will get money. You're going to pay yourself, not either. You have to pay yourself a salary, and you'll get distributions. So an S Corp has certain requirements. It's not something that you just say, I'm going to do this, and it happens like that. You have to tell the IRS how you want to be taxed. And that's you taking control of how much you're going to pay in taxes. So if not, the LLC is a disregarded entity. The LLC does not allot or provide you any kind of tax savings at all whatsoever. It just provides you some kind of limited liability. That's it. There's no tax strategy with with LLC. Now, once you convert to an S Corp, it's endless. You know, the S Corp, the business can now pay your insurance out of the business account, and you can do that as an LLC. However, now you're not going to pay taxes on your health insurance. It's going to be deducted out of it on your W-2. So if you've ever seen a difference when you worked as a W-2 employee, that first box 1 may say a lower amount than what's on Social Security and things like that. Well, that's because your health insurance is not taxed. So box 1 may say 60, but box 2, the other boxes for Social Security wages, it's going to have a higher amount. But that's because on the federal side, you're not taxed on that. You know, that's pre-tax. Those are pre-tax items. Same thing when you become an S Corp. You pay for the insurance out of the business. So on your W-2, box 1 is going to have a lower amount. The other boxes will have a higher wage amount for self-employment tax. But that's just a strategy. And even when you do that, if you have employees, like group insurance rates and things like that, there are tons of things you can do there. So we won't dive into that piece, but there are a lot of creative things you can do within an S Corp to mitigate taxes. But the responsibility for it is that you have to have a salary, and you have to have a salary. You have to be an employee. You can't have any foreign owners. Those are the 3 main ones that come into play. And if you ever do an S Corp, you definitely want to have an accountant. Just because if you do it the wrong way, It could be revoked up to 5 years. I see a lot of people that prematurely convert to an S Corp and they don't implement it correctly. And then they're like, hey, I haven't filed my taxes in 3 years and I didn't have myself on payroll. So I'm like, well, when we file this, more than likely, you're going to get a letter back saying that your S Corp status has been revoked, and that's for 5 years. So if you prematurely do it and then you don't implement it correctly, you don't manage it, when you do need it, it may be revoked. And so now you have to wait 5 years before you can actually do it the correct way, okay? I was gonna make another point and that just escaped me. It'll come back to me. So just think about it. You definitely want to talk about it before you jump into it. And you can always do a late S Corp election. Let's just say you're not sure how the year is going to end up. And you're like, I don't know. I don't think I'm going to do that well. I'm not going to make that much money. And then by like September, October, you're like, oh my God, I haven't been paying quarterly taxes and I made $100,000. Help me. Well, before you actually file that return, you can do a late S Corp election. And if you do it and we have enough time before the end of the year, we can issue you that W-2, we can backdate the payrolls and all of that and implement it in October, November, when you're like, it actually happened. I made it. Like I made $100,000. I made all this money. Now what do I do? But once you do it, it has to be managed. And managed properly can save you a good bit of money. I think I saw something pop up.
Everybody's just bragging on you, so that's all.
I see an orange box flashing. I'm like, what is that?
Yeah.
Okay.
Everybody's just saying how awesome you are and that you need to be all of our accountants is what it is.
Oh. So we're going to jump into the example. The salary is subject to self-employment tax. Your distributions are not. So you'll pay yourself a salary. So let's say you made that $100,000, and that's what this example is going to go into. But you will only pay self-employment tax on the $50,000, okay? The other 50 will be taken as a distribution. So it won't be taxed at all. So no self-employment tax. So that brings your self-employment tax bill to $7,650 versus the $14,000 that it was before. Okay? Does that make sense?
Did y'all hear that? Did you hear this? From 14,000 to 7,000.
And that's
right
just
there.
simply, and you have to find a salary that's reasonable. So, you know, you can't pay yourself $10,000 and like, oh, I see what you're doing here. I got you. Now let's bring that number down more. I'm only going to pay myself $10,000 or I'm only going to pay myself $15,000. It has to be a reasonable compensation. Now, let's just take a different business. So I have a client that's a housekeeper. She has automated her business in such a way that the amount of time that she spends now versus when she started is way less. So her salary used to be $50,000. Well, now she spends probably 15 hours a week, maybe, working in her business because of all the automations that she's put into it. So we're going to reduce her salary because that salary is no longer reasonable for her role in the business. The business is pretty much running itself. So now, instead of paying self-employment tax on a $50,000 salary, we're going to drop her down to about $35,000 and pay self-employment tax on that amount because we can prove that her hours that she's working in the business are way less than what they are right now, than what they were before. So you just want to make sure it's reasonable. I can't stress that enough. And if you're working with the right person, they're not going to allow you to go below a certain amount because you got to be able to prove it. It has to make sense. You can't have a $40,000 or $50,000 salary, but you're taking distributions of $200,000. It has to make sense. And then also what your role is in the business. If you're the CEO, then, I mean, are you going to be making more money than your employees or are your employees making more than you? it has to make sense. What is your role? Are you managing the business? Is it just you? If you don't have employees, it's a much easier argument. But if you have employees, I have another that's a therapist. She owns a therapist practice. Well, she hires other mental health therapists. Well, you're practicing and you own the business. They can't make more money than you. That doesn't make sense. So you have to make sure that your salary is in line with what the business, what's going on in your business. Okay. So back to the example, kind of got off track. $7,600 now as an S Corp. So if you were, single, again, this is a single example, this is how much you would pay in total as a self-employed, as an S Corp owner. Now, I think let's go back to the previous one. It was $31,850. Now it is $24,623. That's a huge amount of savings, and it is 100% self-employment tax. 100% self-employment tax. So this is how it breaks down per quarter. LLC self-employment, S Corp self-employment, every quarter just in self-employment tax, this is how much you're saving. Now, like I said, that first year, this is based on $100,000 net profit. That first year, let's just say you were at about $50,000 net profit and you convert it, you're probably gonna break even. So cut that number in half. So it's like $700 per quarter. So you're probably gonna break even when you set up the S Corp. And that's just because of the back office stuff that has to be done. You have to apply. You have to let the IRS say, hey, I don't want you to tax me like an LLC anymore. I don't get tax savings that way. Tax me as an S Corp. You submit a form. Typically, they don't deny it. There's no reason unless you have to be in good standing with the IRS, and then they won't deny you. And you just simply apply. At that point, it triggers you to have to go on payroll. So now you've introduced payroll cost. So unless you're doing it manually, and have fun with that, definitely not the accountant to do manual payroll taxes. But there's so many different types of software out there that automates this. They're as low as, $40 a month, maybe $45 a month just for yourself to be on payroll. So maybe $500-600 a year. And they'll pay your quarterly taxes. It'll just be like a W-2. You'll run your payroll and they'll pay. You can put it on autopilot. Let's just say cash flow is there, you're not concerned. You put it on autopilot and it'll pay you every week, every 2 weeks, every month, and pay your taxes as well. You'll get the email, here's how much I'm taking out of the account, and you just let it flow. But that's one of the things. You have to be on payroll. Now you have 2 tax returns to file. So if you've ever seen their March 15th tax deadline, that is for partnerships and S Corps. If you have a partnership or an S Corp, then that return is due March 15th. Reason being is that now you will get a K-1. So once you become an S Corp owner, you'll have a W-2 and then you'll have K-1 income. And that's basically saying, here's a summary of what happened in the business. They did have W-2 income and they also had distributions. So it's like a W-2, but it's called a K-1. So you'll have to have that to file your return as well. But that's why the return is due March 15th. So you can have that in time, especially if you have other shareholders. You got to get it to them in enough time so they can file their return by April 15th. And gosh, I think that's the last thing. March 15th, the penalty. So if you become an S Corp and you do not file that return by March 15th and you fail to file an extension by March 15th, the penalty for partnerships and S Corps is $200 per month for a non-filing fee. So if you make this jump, just know the responsibility, the added responsibility that comes in there. Now there is a non-filing fee for personal returns, but it's not $200 a month. And it can max out for the whole year. If you don't file that return before you even pay your taxes, you can owe the IRS $2,400 for not filing. Now, of course, I would file a first-time abatement if that happened, but they may deny it, especially if it's been 2 or 3 years. So, but that's just some of the responsibility that comes along with converting to an S Corp. Any questions? I'm at the end now.
I was about to say, how can we get in touch with you? But here you go. Perfect.
There you go. You can always, you can visit my site. We can set up, I do free consults. So if you want to set up a free consultation, you can go on my site and set that up. You can send me a quick email. I like to, as much as I can, as long as time allows, even if you're not a client of mine, if you want to send me a question via email. Now, it may take me 24 to 48 hours to respond just because I'm working with my other clients, but I do try to, respond as much as I can and help as much as possible, even if you're not a client. Now, if you do hire me, then you can send me a text or even Slack me or something like that. You can give me a phone call if you're in a situation. Everyone, tax stuff is always, it's not a rush, but I always get a phone call. It's like, hey, I got a tax question and I got to go, no, right now. Well, you can get me on the phone if you're a client.
I love that. And I don't know if everybody was on here earlier, but she said she's totally virtual, right? So you can have clients in Montgomery, and that's not a problem.
I have clients I've never seen before. I've never met them personally. I had clients in California in the cannabis industry, Mississippi, Texas, and Florida.
That's
So
awesome.
never met them. We do Zooms. I've had one that I haven't even Zoomed before. It's just a phone call.
And that's what we're doing. So look, you're thriving virtual. So that's awesome. Well, thank you so much, Coco. And thank you, Shacarol, for sharing your bestie with us. Like, that was so awesome. So we really appreciate it. Based on the comments, everybody really enjoyed it. And I want to hear a couple ahas before we go. Tell me what you guys heard and thought. Like I'm like the little Bitmoji was like right now. So we have a comment. I'm at work, Brittany. But Coco, I definitely look forward to speaking with you in the future. Ooh, that's promising. All right, any other ahas, comments? We like to end on that note. It's a Keller Williams thing.
Oh, well, I just didn't know the S Corp, that's what it was about. I thought it was something way more than that. So I'm a note taker, so I have taken so many notes, so I know I will be in touch with you.
And the S Corp, it's structured.
Right.
So, again, as long as you have someone helping you manage it, because there are rules and regulations once you go from LLC to an actual corporation. There are rules, there's basis to consider and things like that. But, if you're just a single member owner, then it's not not a lot to do with it. If you're not issuing stocks and things like that, it's not a lot. It's just simply, I want to save taxes, so tax me like this.
Right. Thank you so much.
No problem at all. Glad y'all invited me on. I appreciate it.
Yeah. We're so glad you joined us. Does anybody else have anything else to finish on?
I just don't understand why she didn't tell me that I can use this child over here.
What did Shacarol say?
Am I understanding how she held out back for me that I can use my child over here?
You can still pay her for work, for 2020. It's not too late.
Go ahead, Tiffany.
Coco, if you were to just leave us with like the basic bare minimum of what you think we should take out of this, especially getting started, would it be to go ahead and set up the LLC and start on the bookkeeping or tighten up on the bookkeeping?
I would create my LLC. The LLC allows you to pivot. So I'm glad you asked that question. In order for you to convert to an S Corp, you have to be an LLC.
Okay.
So if you're not an LLC and you say, oh, I made all this money in October and I want to be an S Corp, you can't. You have to become an LLC, and then the money you've made within that LLC, at that point, now you can convert to an S Corp. So the LLC allows you to pivot however you want to do, however you want to. And in our state, in Alabama, the cost to create an LLC is minimal. It's not like in California and all these other places where like you have like $800. Like sometimes in certain states, like the fee to become an LLC is, the annual fee is like a lot, but it's not much. I mean, $100 a year for your business privilege tax. There's no question. Create the LLC, and that way it'll allow you to pivot once you're ready to make that decision. The maintenance is low here.
And Coco, can you help our people set up their LLC if they're your client?
Now, I don't, I see a lot of people doing that, and I really refer people out to an attorney just because the taxes you pay, that's where I come into play, but the LLC provides legal protection, and you want to make sure that your articles are set up correctly. So it's a one-time thing. Let's just say your board of directors, and I didn't talk about this in here, but family, board of directors, you want to, have them listed on your articles. And the benefit of that, let's just say you want to take a board of directors vacation. Well, you can take your family, and like your husband is on your board, your daughter is on your board, and you're actually going to sit down and talk about business. So you're going to have your annual board of directors meeting in Hawaii. Now you have a whole tax write-off because you've talked business during this vacation, but it's not a vacation. It's it's your annual board of directors meeting.
Oh, Coco, you all right with me? I got another aha. I just want to do things the right way, and you're saying it where, you look at it and you say, okay, well, can you do this or can you do that? You're letting me know we can do things and it's still legal and the right way.
Absolutely. Yeah, when you see the bigger companies, they're going on these vacations, they're driving these cars, the business is paying for it.
Yes.
You just have to make sure it's set up properly. But you're living off the business. Tax code is written for business owners and real estate investors. Like that's who it's written for.
I love it. So that's us, right?
That's y'all.
Yes.
All day long. All right. Well, we're going to wrap up here. Coco, thank you so much. I hope everybody saved her information, and I'm going to share it we have a closed Facebook group for all of our agents. And so I'm going to share that with everybody. So hopefully you'll be getting some calls and inquiries for consultations and lining you up some clients, because I know this has been well beyond my expectations. So thank you so much for joining us.
Hey,
Thank you, Coco.
Katie,
No problem.
Can I add her or tag her in our page?
Yeah, you can definitely add her to our page for sure.
Okay.
Oh, okay, cool.
All the tax questions for all the realtors. I'm just kidding. I'm sending it out to the board. No big deal. It's fine.
Well, thank you guys for having me. I appreciate it. And y'all have a good rest of y'all day.
You too. Bye-bye.